to the So What from BCG, the podcast that explores the big ideas shaping business, the economy, and society. I'm Georgie Frost. In this episode, how companies can adapt to the new era of trade uncertainty, with Marc Gilbert, global lead of BCG's Centre for Geopolitics, and Michael McAdoo, BHI Fellow on Geopolitics and Trade, and founding member of BCG's Geopolitics and Trade practice. Marc, what's your so what?
Honestly, we're at an inflection point where we're now going to enter a new era in global trade. And that's going to show up in tariffs. It's going to show up in regional trading blocks. It's going to show up in a redefinition of supply chains and operating models. That's going to have ramifications across many sectors, if not all, and across all enterprises as we know them today.
Michael, could you sort of set the scene, as it were? What are we seeing out there compared to what you've seen over many years?
So we're really seeing two things right now. One is an unprecedented level of volatility, and that I don't think we've ever seen, at least not in modern history, with tariffs coming on and off, sometimes in a matter of hours, or at least the threat of tariffs coming on or off. But from an absolute level of tariffs perspective, we've not seen something like this since the early 1930s, when the Smoot-Hawley tariffs came into effect in the United States, which led to a number of tit-for-tat retaliations from key trading partners and essentially prolonged the Great Depression.
Marc, how are companies framing this current situation? Is it risk management? Is it growth opportunity, resilience? Is it something else? What are the leaders that you're speaking to telling you about this current situation?
There isn't one sector that's not being impacted by this. And frankly, all enterprises are trying to tackle the situation. It really depends on the enterprise they're leading. For some, they're in a unique position. They have a large, substantial American footprint that's serving the American market. So their advantage. For the company, it's got high asset exposure in the U.S. for the U.S. market. Its growth, its share is taking advantage of it. For others, they're primarily importing into the U.S. and they're disadvantaged. So for the disadvantaged ones, it's about risk, it's about resilience, it's about cost takeout, it's about adjusting footprint.
So what does that mean for business, Marc?
We need more suppliers and we need more country of origin. And that means more optionality, and there is a cost to that. So to have a resilient supply chain with multiple sources of supply or multiple suppliers, often it means a little bit more cost. And the CFO knows that, doesn't really enjoy it, but it is a fact, which is why in parallel, the leaders are saying we're going to invest, like 86% have said we're going to keep deploying AI and technology to get cost productivity, because they know ultimately they still need cost productivity, while they're creating more resilient supply chains by expanding their sources of supply, whether it's the number of suppliers or whether it's the countries that are serving them.
Michael, is there an argument for companies to just sit on their hands and wait for the storm to pass?
I wouldn't advise that to anybody at this point. I mean, it's hard to think of a sector that's not affected. We like to break this down into first-order effects. In other words, my company was specifically affected by something. Second order effect is, well, my supplier was affected or my customer was affected or something like that. And then there's these kind of more macro effects, things like potential price inflation, at least for one cycle as the tariffs get absorbed into the base cost of things, possible dampening of economic growth. But I can't imagine, unless you're 100% domestic, producing, transforming, selling in a single market. And even then, I think you'll be hit by some second order or even these indirect effects.
It's not like we didn't expect that trade might be on the agenda and some disruption might be coming down the track, as it were, some months ago. So has this caught leaders off the hoof?
Well, there's an old saying in military strategy that one of the things that generals tend to do is fight the last war. And I think people thought that the Trump 1 administration was quite dramatic in terms of a series of tariffs on washing machines, solar panels, steel and aluminum, and a whole suite of tariffs on China. I think what's happened now is it's the scale and the scope of these tariffs that have really taken business by surprise, plus the volatility that I mentioned earlier.
This time, they were expecting it. I mean, it was proclaimed throughout the entire election period. They were expecting it. Did they expect this materiality, this uncertainty? No. But unlike Trump 1, they were ready. They'd set up teams. They've done their analysis, and they were preparing for something, just not this level of scope.
So if they were preparing something then, Marc, then surely a lot of companies were pretty well set.
On certain dimensions, absolutely. So we saw the amount of inventory being brought into the U.S. as of election day. Like the amount of goods coming from China. Right now, inventory warehouses in the U.S. are full. They were ready. They were pre-ordering, pre-shipping, pre-stocking, preparing for what was the eventuality of tariffs. Did they expect the tariffs to hit all markets and all segments? No, but certainly the shipments from China came in very, very high. And then as soon as the inauguration, they started shipping in from Canada and Mexico as well. So that is an example of preparedness. They had not, of course, reset supply chains. That takes years, and if not, multiple cycles to be able to reset a footprint.
Michael, do you agree with that? Were they ready?
Well, I think there's being ready and then there's being ready enough.
Nor did they expect to be announced and then paused. So that happened with Canada and Mexico. It's happening with reciprocals right now. So leaders are struggling to deal with these pauses. Right now, it's difficult to take actions on certain fronts because there's uncertainty of when will this pause end and where will it end in terms of scope and percentage.
Marc, we have heard it before on this podcast that uncertainty demands a different kind of leadership. So what are the specific capabilities that companies, that leaders are needing right now?
They need a ton of agility for sure, but there's two pieces that are standing up right now as very, very critical. So 70% of executives surveyed, BCG recently did a survey, called out that geopolitics is now top of the agenda. So they've realized that, well, maybe we're not perfectly geared up to deal with this geopolitical dynamic. So they've decided, many, to enhance what we call geopolitical muscle. What does that mean? Better ability to sense the changes dynamically that are happening day to day, frankly, hour by hour. Maybe there's a change happening right now. I don't know. I'll find out when I hang up this call. Then they've put the plans in place to deal with all the data that's coming in and act. And that geopolitical muscle is not now working as a synthesis of the news, but rather to have in-house capabilities with the right data set that influence capital planning and strategic planning.
So, Michael, a geopolitical muscle there. What do you think? What specific capabilities are companies needing right now?
I think the other piece that's very important is just the competitive analysis. A lot of our clients have been looking at their own operations and how to mitigate within their own supply chains, within their own four walls. But everybody's in a competitive position in this, whether you're a company or a country. Let's pick India versus Vietnam. People in India start saying, wow, are we now able to serve that US market more competitively versus Vietnam? And can we attract production from Vietnam to India? Not because they're absolutely better off. They're going to be 20-something% more expensive than they were last week, quote unquote, but they'll be 20 points better off than someone that got that high tariff.
And Georgia, this brings up a good point. Some nations have awakened and realized, well, I'm actually better off if it ends up here.
I just want to dig a little deeper when you spoke about the geopolitical muscle. How do leaders factor geopolitical developments into their near-term and long-term strategies?
It's mostly long-term. So it's around capital allocation decisions, M&A actions, big strategic moves. And they need to understand and appreciate where the world is heading, where the partnerships are emerging, where the partnerships may be breaking down. Therefore, where I can make investment. For example, most leaders, as it pertains to serving America, have frozen their capital decisions for the moment because they just don't have enough certainty to be able to do the multi-year cash flow statements that they need to generate the right level of confidence in their return on invested capital. They know that the stability will come back, and we all hope it comes back soon. And when it does come back, we will see those decisions being made. The other place they're making it is a lot where Michael was at, which is the here and now. I've got some real things to do right now. So pricing, well, my competitor is taking price. I should take price. Maybe we want to take share.
Michael, for companies that haven't yet built strong geopolitical capabilities, where do you start?
Often you find that this stuff is dispersed across different functions. Some might exist in the classical functions of government relations, but maybe others in regional country structures that have this ability to sense and detect what's happening. So I would first do a scan of what you have in-house. But I think the real strength is in terms of building that internally in the company in a way that you can actually not just sense these things, but capture it and act upon it across your organization. It isn't just off in some corner somewhere that's got to be integrated into the business, that you can actually make decisions and protect your competitive advantage.
Leaders have realized that, and they're trying to institutionalize it by having their own internal advisors and hardwiring to strategic and capital decisions. That's where it's really, really important on the big move, including M&A. We've seen some firms, call out a chief geopolitical officer in the C-suite. That's novel. That's new. I think that's an indication of where it should go. This doesn't apply to all firms. It applies to firms that have global footprint and, they're not domestic firms.
I'm curious, are there particular sectors that are further ahead in adapting than others?
I'm going to speak less to those that are further ahead to start with. I'll speak more to those that are severely impacted. In the goods categories, fashion and luxury, apparel, this is existential for them. They're not the highest margin business. They source from Southeast Asia. All of a sudden, they're being heavily tariffed if the reciprocals are followed through as per plan. They're preparing hard, but it's not easy. It's not overnight that I can make a shoe in America or produce a garment in America at a margin that delivers a price point that Michael and Marc like. It's not tomorrow morning. So for fashion luxury, heavy hit. They are all hands on this. They're trying to figure out how to reduce their cost structure, migrate the supply chains, and work with the White House to find out a path that's successful for them. They're also trying to see if they can get an exemption, just like the consumer electronics industry did. It goes beyond them, of course, durables, manufactured goods, automotive, and then medtech. And I'm just going to take medtech for a second because medtech is in a different position. It's slightly higher margin than, say, apparel, and they're quite dependent on an Asia footprint. But because they have higher margin, they have a little bit more time to make their adjustments. Some are creating the parts depot in the U.S. in response to this to try and reduce the tariff position that they're exposed to. Another one is planning to, over the next 5-10 years, increase their footprint in the U.S. to serve America. So it depends on the enterprise. But Michael, you may disagree with me. Go ahead.
No, I was going to say, I think in terms of, are the industries that are more adept at dealing with this, I just simply say more experienced in terms of, you have sectors like aerospace where geopolitics and trade have been inherent in the industry for decades. The first aircraft flew in the early 1900s with the Wright brothers, and by the First World War, we had fighter aircraft, right? So that's something that got into the geopolitical space very quickly. So they're quite far ahead. I think some of the technology sectors, like semiconductors, were dealing with this long before this most recent administration came along. And so I think that's another kind of industry that's a bit farther ahead. But I think in general, people's preparedness now is a function of how exposed they perceive themselves to be, as Marc said. And I would point out that I think the margin structure of the industry is extremely important, as Marc was alluding to. If you think about, I don't know, a luxury handbag that might sell for $2,000 that maybe costs $400 to make, well, that's the ability of that bag to absorb even a 50% tariff, let's say a 25% tariff, is much easier than an industrial product with a 10% margin or a piece of fast fashion clothing with very thin margins. So I do think there's, even within a sector called fashion and luxury, there's differentiated responses by segment and by company within those segments.
Many clients in the financial services sector think insurance, think financial services. They feel immune to this. But the reality is, as we go into the details and we go into the discussions, they realize, whoa, wait a second, it's my investment portfolio, it's my loan portfolio. They have realized that even the second and third order effects of what's happening right now will impact them just as much as it is those that are very dependent on goods.
Could this all just revert back? We're back to business as usual in a few months when things have potentially died down.
So I'll take this first. And Michael, you may agree, you may not. So just on the tariffs, they're very sticky. Once they're in place, they bring money to the federal government, which the federal government likes, and they get negotiated down. Negotiations are long, they're onerous, there's multiple parties. So in President Trump's first term, we saw the rate of change in the tariffs that were imposed. In President Biden's term, all of these tariffs remained. In fact, some of them were elevated. Now, in President Trump's second term, we're seeing a change to the pace, rate, and materiality of the tariffs. So again, this period of, they will go away shortly, is wishful thinking. One cannot plan for them to go away once they've stabilized. And I repeat, once they've stabilized. This level of uncertainty in terms of they're on, they're off, we'll see with the negotiation, that's going to take some time to go through. It may be months. If you're asking me to predict when, I'm not going to be able to. But hopefully before the end of the year, those points are behind us. So that's piece one. Piece two, it's not an uncertainty, but it's a reality that global trade agreements that were institutionalized by America is a thing of the past that we now need to live with. I've said a lot. Michael, you want to pile on or disagree?
Yeah, I think I'd like to just pick up on your last point. I think this is where it starts. It starts at the level of the trading system. And we had a system that was based on rules, that was based on international treaties. And from that point of view, the global system is now looking at a new reality. You have the United States, you have China. So now you have these two sort of poles of economic and political power that are at odds. You have countries that would like to continue trading more freely. So like Canada and Mexico, Peru, Chile, the ASEAN countries, the European Union. So perhaps they'll start looking at how they can deepen their trade relationships and not be overly dependent on either the US or China. Then there'll be a fourth group of countries, perhaps India and some others that have been historically non-aligned, that will try to make their way among all of those different new trading blocks. And so that's going to be a very different reality for global supply chains as they navigate that big environment.
While Michael is painting these pictures, it is difficult for me to see a world where consumption in the US drops and the GDP drops to a place where people back out because of this dynamic. It's more of I will adjust myself so that I still have a very good, successful business in the US, and I may have a very different model for the Global South, for example.
I actually agree with that. And I think what the point is, people made that decision about China 5 years ago. I'm either going to serve China or not serve China, and I'm going to be careful before I put new capital down there. And China saw that consequent drop in capital and the consequent drop in a related drop in consumer demand. The US is going into a new mode. It'll still be a very large consumer market. The European Union's a large consumer market. And you've got nearly 700 million growing consumer market in Southeast Asia. You've got 1.3 billion in India. You've got 1 billion plus in Africa growing and the youngest population in the world. So people will be looking where else they can go.
I think for the EU, for Canada, for Mexico, for many nations, it's actually a good wake-up call that while everything Marc says that the US is a phenomenal growth engine and consumption engine and economically viable engine, it's good to have diversity and diversification and may actually yield some better, more stable, more sustainable outcomes.
So how do you work out perhaps which countries you should be looking at globally? How do you shift your focus? What do you need to be thinking about?
Well, I think what we're seeing is leaders have accepted the fact that there's multiple poles, and to serve multiple poles, they may need to have a distinct operating model, a distinct supply chain, a distinct offering. For China, that's different from America. For Southeast Asia and the Global South, that's different. And that, I believe, is the direction to travel. You can call me in 10 years and tell me if I was right or wrong.
If you're a company, how do you figure out where to put your resources in this very uncertain economic world?
I think it depends on where you start. I think certainly the nationality of your company and the nationality of your capital will be driving that decision. I think the answer is different for a Chinese multinational versus a US one versus an Indian one. So you need to start with where are you going to be in a friendly environment based on the nationality of your capital. And you've got to also look at which markets you're trying to serve and from where. If you're able to regionalize your supply chain and have sources of supply and management and almost independent operations in each of these poles we're talking about, that could be an inherently resilient model. You won't have global scale like you had in the 90s and 2000s, but you'll be able to produce on a global basis.
In addition to what Michael was saying, the economics of the firm will justify the investment or not. And if I can't serve the Global South economically viable solution, I won't do it, even if it's friendly.
Michael, you said it wasn't good enough for companies to just sit on their hands at this time. But how do you balance the need to react and to react quickly with the need for caution when it comes to all these changes?
Well, the first thing I would say is understand what are the so-called no-regret moves you can make regardless of different scenarios. You need to think in terms of scenarios and then think in terms of signposts toward those scenarios. If this happens, I thought about that. Here's my exposure. I will do this as a result. So, for example, if you're a North American producer and you've got a supply across Canada, US, Mexico, right now, those products, if they're compliant with USMCA, are exempt. There's a pathway to renegotiate that agreement, which was foreseen in the original agreement. If that negotiation is going well, perhaps that footprint can be protected and continue to have that privileged access to the U.S. market. If we see that negotiation go sideways, be broken off, if the agreement is abrogated, then you have a contingent decision to do something about whether you continue to produce and pay some punitive tariff, or do you readjust that supply chain for different markets.
And Georgie, some have built scenarios and substantiated them with analytics, even AI, so that they have a better predictability. So if they have enough data points that show the USMCA may not be successful in the negotiation, boom, they can act. It's very hard to read if it's going to be successful or not in the negotiation without having a lot of data.
What about the now what? The next practical, immediate steps that companies can take?
Well, I would get working on those no regret moves right away, find out what they are and get moving on them. And secondly, several industries have proven that it's not too late to shape policy. So if you've got a way to get your own operations, your suppliers, your customers aligned to say, hey, this industry, for whatever reason, should not be receiving this tariff. We're actually an exporting industry. We need these products to build things in the US and re-export them, for example. These are things you can do. And the administration has shown it will change, whether it was from those initial tariffs, the auto industry, some of the technology companies that have gotten temporary suspensions for things like smartphones.
On the tariff side, pay attention to USMCA. Right now, if you're compliant, it's very helpful. Services is on the horizon. It could affect you directly or it could affect you indirectly. And the third piece has to do with this shape policy, which I call get an exemption, get an exclusion, go negotiate with the White House, either as a country, a sector, or an enterprise. On the non-tariff side, let us not lose sight that U.S. policy is very dynamic, and it isn't just tariffs. We've got regulations and deregulations. We've got labor. And the last but not least is the corporate tax. If the corporate tax is reduced to 15%, it changes the economics overnight.
Marc, Michael, thank you so much. And to you for listening. A note to the listener, the world's trade and tariff situation is highly volatile. We'd also love to know your thoughts. To get in contact, leave us a message at thesowhat@bcg.com. And if you like this podcast, why not hit subscribe and leave a rating wherever you found us? It helps other people find us too.